Hello and welcome to The Resilient Investor with me, David Stevenson. My partner in crime, Sam Ridley, is away for the next couple of weeks, but we will soon be back with an episode looking at value investing and how to buy good quality, cheap stocks at a great price. This week, though, we're going to talk a bit about global equities and how to invest in them in a very diversified, globally diversified way. And to talk about that, I've got Craig Baker, who is the manager at the Alliance Trust Investment Trust. Now, that's probably one of the biggest, certainly one of the longest established global equities investment trusts. And they've got a pretty unique mandate. They work with different underlying fund managers to capture everything from, emerging market growth, UK value stocks, all the way through to mega large cap global equities. So Craig is the perfect person to talk a bit about how to build a diversified portfolio of global equities. Anyway, I called up with him a couple of weeks ago, and here's our conversation. Craig, let's start by talking a bit about equity markets globally, really, where we are at the moment. Now, I know that most investors are told quite rightly, stick with investing for the long term and understand that equities can be, risky and volatile, all the usual caveats. But still, people are always interested in where the markets are at the moment. And we do seem to be at an interesting spot, don't we? There's nervousness about, I think it's fair to say. But markets have done pretty well. Certain markets have done pretty well. I mean, US stocks done pretty well. Japanese stocks done particularly well. What's your sense? I mean, we can only guess at this, can't we, Greg? So what's your sense at Alliance Trust of where we are at the moment?
Yeah, well, you make some good points there. We are reasonably cautious about markets as we stand today. You just look at where interest rates are. You'd look at it and think a recession is relatively likely at some point, but the markets have been very resilient for some time, and a number of people have been predicting.
Yeah, including me, I might point out. Yeah,
absolutely. And one of the things we try and do with Alliance Trust is not take big macro views in the portfolio for that very reason. We don't think many people are very good at calling those things, and so we ensure that stock selection drives everything. However, we do think about where are we in our overall view on markets when we're thinking about the amount of gearing in the portfolio, for example. And at the moment, we're relatively cautious. And so we're at the lower end of the range on gearing. But
just to say, gearing means you can basically borrow extra money to invest in equities because you think there's a big opportunity.
That's right. So most investment trusts will run a little bit of gearing all the time, to be honest. And at times when they're particularly positive about markets, they'll borrow a bit more money and put that into the portfolio. It's one of the advantages of an investment trust, the closed-ended structure, and has actually led to investment trusts typically outperforming open-ended equivalents for partly that reason.
But you're low at the moment.
We're low at the moment. So we're at about 7% of the portfolio would be borrowed and reinvested. So you're at 107% rather than 100%.
And when's your maximum been?
Well, we typically are in the 7 to 13% range. We don't take big positions. Now, we can go wider than that. But we wouldn't typically, unless there was a very extreme reason to be very fearful or very positive about markets. So after a very big fall or a very, very big rise in equity markets. So we're at the lower end of the range. Bear in mind that that's the amount of borrowing. You do then have some cash in the portfolio that the managers own. So actually, you're really only about 4% to 5% at most levered at the current point in time. So we reflect that in the portfolio. But whilst we're cautious from a top-down perspective, actually we're finding a lot of stocks in the portfolio that the managers are really excited about, that they've been delivering as a company on the earnings that are expected or actually above what the market was expecting in earnings. And some of them just haven't seen any market cap appreciation. The share price hasn't gone up.
That's the thing. A lot of people think actually all this uncertainty around inflation is doing, very high, but actually corporate earnings for a lot of big, particularly American, but not only, have been doing very well.
Yeah, remain very, very robust through a lot of this. And so a lot of what we do is challenge the stock pickers in the portfolio around, are they owning the kinds of companies that will be able to withstand a recessionary environment? And they're very confident about that in a number of those stocks. That's not to say every stock's going to do well in that environment, of course, but they are confident that they would weather such a storm. And so there's lots of stocks that can be pointed at by each of the managers, no matter what style of investing they've got.
Managers, because that's it's worth explaining. And you've got kind of managers beneath you who you pick. You've got particular mandates, so it's almost a kind of fund of fund approach almost.
That's right.
And they've got different styles, geographies, that kind of stuff. So I mean, have you upped the percentages of some managers versus others to express preferences?
Yes, and we do that on a regular basis. So that's primarily a rebalancing exercise. Okay. So what we try and do is make sure that no big style biases are in the portfolio. Yeah. So we haven't got the value-oriented managers ending up being a large part, or the growth managers. Yeah. We try and avoid having big country positions relative to the benchmark index, which is the MSCI All Country World Index, which is market cap of the globe, essentially.
And that includes emerging markets.
That includes emerging markets, that's right. And so we're mainly rebalancing to ensure stock selection's driving everything. However, we will be, at times thinking about where we're confident returns are likely to come from over the course of the next few years.
And where are you confident the returns will come from in the next couple of years? Where have you upped it?
Yeah, it's an interesting one. So a lot of the rebalancing was taking place because growth managers had done incredibly well going through to the start of last year. And, if we hadn't been taking profits from those managers and rebalancing to the managers that had struggled more, we would have ended up with a very big growth bias. And so that was something we were doing.
And by growth, most people would understand that as probably slightly more techie orientated.
Yeah, a lot of the growth managers have been overweight. The Magnificent Seven, as they're called at the moment.
Mega caps.
That's right. The likes of Amazon, Apple, Alphabet, or Google's owner, Meta, those Tesla.
Nvidia, of course.
And Nvidia. So those kind of stocks have very much driven the market for quite a few years now. And so a lot of growth managers will have those types of companies in their portfolio. There'll be other growth-oriented industries that they'll be invested in as well. But those have been very dominant, whereas the more value-oriented managers are in other sectors. And so one of the big things has been around the energy sector. And so value managers that have done well in recent times have been ones that have been invested in energy, and value managers that haven't done well have not been invested in energy. And that's really been the call for the value managers, whereas the growth managers have generally done well, but those that have had large positions in those Magnificent Seven stocks have done even better.
So where are you now? What looking forward, what have you shifted that balance?
Interestingly, we're pretty neutral in our position in the Magnificent Seven, for example, whereas we were more underweight for a period of time. Now, there's quite a mix within that. By number, more of the managers are underweight the Magnificent Seven, having seen more them do what they're significantly underweight. Whereas we have a couple of managers that are overweight in that space. GQG is one of the managers we have.
Emerging markets, aren't they?
So we've got two portfolios with GQG. Oh, right. So they run a 20-stock best ideas global portfolio.
Which includes developed world.
Yes, and then they have a separate emerging market portfolio that they manage for us. They are the one manager in the portfolio that changed the portfolio around more often than the others. The others tend to be very long-term stock pickers, stick to their style and approach, whereas GQG, they define, they're called global quality growth. That's the GQG element of it. But their definition of quality growth is all around the stability of the cash flows that they're getting from the companies. So they've actually had a lot of energy stocks as well as a lot of technology stocks.
All right, okay. Interesting combination.
Exactly. So you might more typically see a value manager with the energy position and a growth manager more with the tech position. They've had both. But there was a period 2-3 years ago where they were very heavily into the tech stocks, did very well out of them, made a complete shift to energy, underperformed for a short period of time, and then did very well through the energy stocks. And more recently, they've been buying back some of the tech names.
And is there, it's difficult to, I suppose, answer this. Is there any one well-known stock that you are, once you look down to the company level, you're quite overweight in?
So the overweight positions, the biggest overweight positions, Alphabet of the Magnificent Seven, Alphabet would be the one that we're very overweight. On the flip side, we've had zero or very close to zero in Apple.
Oh, really?
And zero in Tesla throughout the whole period. But significantly overweight Alphabet. Outside of that, things like Visa and MasterCard were significantly
never going to go away, those two companies are.
So those would be some that I would pick out. But actually what you tend to find, because we've got around 10 managers in the portfolio, you tend to find that we've got a lot of stocks that are only held by one manager, and so they tend to be about a 1% position. So we don't have very concentrated positions in a small number of stocks.
You mentioned a benchmark a few times, and the benchmark you use is lots of acronyms in investment, isn't it? MSCI, ACWI, or the All World Index. Yeah, but
that's right.
There is, I suppose, the ultimate question is, why don't you just buy an ETF, for instance, cheaper, although you're pretty cheap, but cheaper, and just be done with all worrying about whether or not your managers have got the right idea or the wrong idea. Are they overweight this? Are they underweight this? Just to say, to take the risk out of the equation. I suppose a lot of people might think, they put you in a bit of a peer group between, do I do an index or do I do Alliance Trust? How do you answer those people who just say, better to go cheaper, take all that manager selection risk out of the equation?
Well, look, I think ultimately, as a retail investor, putting your money in something that's low cost makes a lot of sense. Yeah. So there's no doubt about that. And we've tried to ensure that the Alliance Trust OCR, the total costs of the trust, is actually pretty low, and it looks very attractive relative to other multi-manager approaches that are out there. Yeah. And indeed looks pretty low relative to single manager approaches that are out there. So no denying that looking at costs is an important thing that investors should do. The second piece, though, is to think about what's the actual risk that matters to you, because is it the tracking error to some index, or is it you're worried about absolute risk? And it's not clear that the passive approach is lower risk than the Alliance Trust portfolio, which has got around 200 stocks, where 10 of the world's best stock pickers that have got a long track record of doing this are picking just their 20 best ideas of all of the companies that are out there. They're thinking through multiple issues, both the long-term prospects for the company, but also sustainability issues and the like, which you're not getting that done in a passive approach. And bear in mind that the passive index has ended up becoming very concentrated in a small number of companies.
The Magnificent Seven.
The Magnificent Seven, for example. And it's about the most concentrated it's been in a few decades.
Long.
And if you actually look through history, there have been periods where the index has become quite concentrated. But a decade later, those are very rarely the same stocks that are driving the market. And so if you look at it, do you want to be in a passive fund that guarantees you're going to have those large positions in a small number of companies? Or do you want to be with stock pickers that are thinking through the issues and don't have to be as concentrated as that? As I said, at the moment, we're not particularly underweight. We are a little bit underweight, but we're not particularly underweight those Magnificent Seven stocks. But there will be a time where we are. And if the investors on our behalf think that those look unattractive, then they would have a much lower weighting, and you'd be reducing your risk from that concentration perspective.
Another alternative approach a lot of investors take is, so effectively, you could quite easily build an approach where you just say, look, classic 60-40, I'll have 6% equities and I'll have Alliance Trust or a passive version thereof, and I'll have a bond fund, be actively managed or passive. And just be done with it. Nice and simple, kind of two fund approach, 60-40, whatever your mix is. I mean, I'm only labouring that because that's a kind of middle ground. But other people might just go, well, I'm actually going to pick regions and I'm going to pick styles, which in a sense, that is what you do, yeah? And they just say, no, actually, I think, and this is true for a lot of investors in the past, they just think that I think Japan is dirt cheap, for argument's sake, yeah? And by the way, they were probably right a couple of years ago. But Japan is really good. I don't like emerging markets, yeah? So they might take a regional approach. Or you might go, I like particular styles. I actually much prefer, I'm an all-in, 100% risk kind of person. I'm going to go all-in growth managers, and I'm not going to do value because value has not done terribly well over the last couple of years. What would you say to those investors who think that kind of selection is worth their bother?
Well, I think I would say that there are very few investors that I've found over the years that are good at making those calls. They're quite binary calls at times.
They are,
Does equities look attractive or bonds?
Yeah,
Does value look attractive or growth? Does Japan look attractive or the US? There's a limited number of decisions you're making, and there's always an element of skill and an element of luck in every outcome that you get. When you're doing that across picking from thousands of companies and you're putting about 200 of those in a portfolio, ultimately skill will come through, that the luck will even out in the positions you make. If you're only making a small number of decisions on a country or a style, you could get very unlucky on that. So the general way we look at it is that you can invest with a pure growth investor, and they'll do very well at times and then they'll do very badly at times. Most of the styles will even out over the long term, but you'll just get much more volatility if you stick with one of them. And you'll have volatility if you switch between them and you don't get the exact turning points correct, which most people never will. And so we feel that if we pick the best growth managers, the best value managers, some that are strong in large cap, some that are strong in mid cap, and we rebalance between them over time, we'll get the same kind of performance outcome as if we just pick the best growth manager or the best value manager over the very long term, but we'll do it with a lot less volatility and pain throughout. And the problem with volatility is that you are feeling the pain and you're almost forced to make changes at probably the wrong time. Often you'll be leaving a style or a country just when it's about to change because you felt the pain for too long and don't feel as though you can carry on with that position. So your example in Japan may well look cheap today, and we actually would agree, but it's looked cheap for a decade plus. And you would have been wrong if you'd done that for a long time. So it's quite easy to say, oh, it was obvious now in hindsight at the start of the year you should have been in Japan. But someone would have said that a decade ago and you'd have been very wrong for 9 years.
I just want to pick up on one thing, though. Markets can, I think it was J.M. Keynes who said, markets can stay irrational long and you can stay solvent. But markets do. Again, Robert Shiller, the economist, has sort of talked about the power of narratives being very prevalent, very powerful, and lasting much longer than everybody expects, which in a sense is just a nice posh way of saying that momentum can last a lot longer than everybody thinks. And there is just, I suppose, one argument I have heard, which is just says, you know what, if you're all in for equities, and you decide equities is your thing, and you're willing to take the risk of equities, and that's why some investors aren't, and they choose bonds as part of their mix. But if you're all in for equities, actually, by and large, over the last 10, 20 years, just saying I'm going to put everything on the red, which is growth, and tech has done really well, actually, because value has done pretty badly, actually, for a very long period of time. So there is an argument saying where that brings us back to Robert Shiller and that kind of solvency argument is just that markets can stay quite irrational. If those of us who, from a fundamental point of view, think the valuation of Nvidia is just crazy, or pick any stock in the growth pantheon. But actually, it's done all those kind of things have done very well for a very long period of time, and thus, although your approach, which sound very rational and actually makes sense, it could just miss out on big secular themes and bull market rallies where favouring a particular style, because you, by the way, like many of us, adopt a kind of rational attitude, which is manage risk, manage volatility. What do you say to that kind of, maybe sometimes rationality is not your best friend in markets?
Well, it's a good point, and the issue with this is that the alternative approach works very well for a long period of time until it doesn't, and then it suddenly works very, very, very badly. So if we look at why growth has done well for a long period of time, we've had an enormously long period of interest rates just falling forever. We're in a very different environment now. That doesn't mean unequivocally growth isn't going to do well, but I certainly wouldn't be extrapolating what the last decade has shown for what I want to invest in for the next decade, because interest rates and inflation are in a very different position from where they were at the start of that decade or at any point until the last 12 months. And so I would warn against doing that. Now, of course, you don't, when you're running a nice balanced portfolio and you're outperforming the market cap index by a small amount each year, that looks quite dull when a couple of growth managers are outperforming every year by a lot.
Yeah.
But suddenly it doesn't look so daft when 2022 comes along and there's a massive rotation in the market. Now, of course, 2023 has seen that flip back.
Yeah, flip back.
But could 2024 be similar to 2022? I don't know. I feel more confident that over the long term, if I find great stock pickers and put a number of them together that think about the world differently, I'm probably going to do well no matter what the market environment comes at me. I don't have to worry about those big macro things. Let's look at something like geopolitics. Who realistically is going to be able to predict what's going to happen? A sudden war breaks out. We've seen that happen in recent times. Things that we wouldn't have envisaged, not long before that. Those are not things that we can predict. What we can predict is whether a company looks to be able to produce better earnings. We're going to get some of those wrong, but if we're doing that over the course of a couple of hundred stocks, get quite confident that good stock pickers can do that. And if we've balanced them such that they're all looking at the world a bit differently, that really helps you get a much more improved return per unit of risk.
Two last very quick questions and then we'll finish. One, you sort of got around to it, and we know I have never finally actually. I'll put you on the spot, but what have you increased your exposure to in terms of styles or geographies?
Yes, so we have increased a little bit the value bias in the portfolio as to where it was prior to that. A little bit more in the outside of the mega caps and down the cap spectrum. But perhaps the biggest change is that we did actually introduce a Japanese equity specialist. Now, this wasn't us taking a view that Japan looks cheap and therefore we want to invest in it. This is actually, we think that there's a massive opportunity for a bottom-up stock picker in Japan that hasn't been the case for some time because of some of the changes that are happening in regulations in that market.
Much more corporate governance friendly, aren't they?
Much more corporate governance friendly, and indeed you've had the Tokyo Stock Exchange actually pushing companies that have got a price-to-book value of less than 1 that they have to show what they're doing to get it up, and so they're actually starting to use cash on the balance sheet appropriately.
So Japan's looking more interesting.
So it looks much more interesting. So we've had a manager come in that's a Japanese specialist because a lot of these companies are slightly away from the mega cap. So having someone that speaks the language, knows that market very well, goes down into the mid cap space rather than just the large cap space.
And one very last question, Craig. I've borrowed too much time as it is already. I'm going to ask you to get your crystal ball out and just, do you think any sense that, I mean, none of us know, do you think we are heading into a slowdown, a recession, a cataclysm? I mean, who knows? I mean, none of us know, do we? What if you had to suck your finger, put it in the air, what do you fear? Where's the way the wind blowing?
So I think our view would be, and the reason we're cautious is that we probably would expect to see a recession. Now, it doesn't mean a cataclysmic event, as you said. We're not necessarily predicting that. We're just thinking that growth has got to tail off a bit from where it is. Interest rates where they are would suggest that that's the case. As a result, we're cautious on the gearing, but we still think a number of the companies that are in the portfolio can do very well in such an environment. And it also means that there's a lot more uncertainty than normal because you really could have a wide range of things that could happen with such an extreme increase in rates that we've seen. And as a result, not having a big style bias, geography bias and the like, I think is going to pay dividends, and having a pure stock selection driven approach. And that's really what Alliance Trust is all about.
Thank you very much, Craig.
Thank you.